Recipes for technical trading success in Cook's Kitchen.
Where does the bear hunt rally end? I say it ends soon, and I'm going to tell you why. Notice I'm not calling it a bear market rally because it's not confirmed that we're in a bear market. A lot of people are just calling it a bear market. You know, we'll see how this plays out. The S&P could find a way to hold up this year and not make greater than a 25% correction, and we find a new rally on our hands. But it all depends on earnings. I jump ahead. Let's look at the charts first. Here's a chart that I showed my members after the February 12th close, when we had that fake out bottom. The S&P tried to make a new low, goes down to 1810, fakes everybody out. We got OPEC rumors of love and cooperation, and the market bounced. But anyway, what I did that weekend is I drew up some scenarios, as I like to do, of looking for a relief rally that was confirmed by that double bottom on February 12th, and what we could expect. My ideal scenario, the most probable one I thought, was a rally up to S&P 1970, the black path, that middle path. But I also allowed for a much greater relief rally all the way up to S&P 2040, the scene of the crime, so to speak, on the opening day of the new year. We had closed around 2040 on the S&P, December 31st. We come in January 4th, the first trading day of the new year, and bam, they start selling stocks immediately. We were down 5%, over 5% that week, from 2040 to 1925 in that first week of January. All right, so back to this scenarios map. We've obviously achieved the black path that I called for on February 12th. And we are on the verge of moving into that green path where this market could take on resistance at S&P 2000 and try and fill that gap up at 2040. I'm going to show you some reasons that I started to become more optimistic about a relief rally after February 12th, after that, that sort of bottom, the possibility of a W. What happened that day was, while the S&P made a new low by a couple of points, there were tons of breadth indicators that were not making new lows. And you call this bullish divergence. So you could look at that in terms of the number of stocks in the S&P 500 above their 200-day moving average. That did not make a new low. In fact, it had found support sooner. Here's another one. This is the total number of U.S. stocks, new highs minus new lows. So basically net new highs. And you can see in January, we made the first dip down to S&P 1812, that this indicator dipped to minus 2,400. This is a total U.S. market. Net new highs were negative, obviously, because we were making a lot more new lows, and that came in at minus 2,400. But in the second week of February, this indicator wasn't anywhere near that. It was only at minus 1,200, as you can see on the chart here. So there were a lot of breadth charts like this that were not confirming new lows for the stock market because they were making higher lows. That's a bullish divergence. So this is something we looked at on February 12th and coming in to the week of February 15th, looking for this relief rally. All right, here were the targets for the relief rally, other than that, the black and green paths I drew. There's a lot going on in this chart, but it has 5 basic things to it that you want to pay attention to. And this is the SPY chart so that I can show the gaps. First of all, you've got the W structure here, right? That's the W bottom, classic. And so I made this chart on the 22nd of February. What I wanted to highlight, the green zone is what I call a volume vacuum. So there was low volume, as you can see. I'm showing the volume bars on the left of the chart. There was low volume there. Price tends to get sucked in there like a vacuum. Okay, that's the second thing. You got the W, you got the volume vacuum. The red circle are the gaps. You know, when we came in, I mentioned coming in January 4th, we gapped down. We also gapped down on January 6th and again on January 7th. Those gaps tend to get filled, right? Most gaps tend to get filled. And as long as if we got sucked into the volume vacuum in the green bar, then we take on resistance, the green zone rather, we take on resistance. S&P 2000, roughly 200 on the SPY is the red line. We take on that resistance and try and fill some of those gaps. Also, I should note the Fibonacci retracements. That green zone of roughly S&P 1950 up to 1980 had several Fibonacci retracements. Basically, the 50% retracement and the 62% retracement. And that's going from the high of 2080, the last swing high of 2080 in late December, all the way down to 1810. The market is retracing. 50% up is about 1950, and about 62% up is around 1980. We've achieved those targets, but this thing still has legs to go. Let me see if I covered everything. Oh, the 200-day moving average. I left that out. The red line here comes in at 201.50 on the SPY. I believe, let's just call it 2020 on the S&P. So that 200-day moving average, obviously, all of these things are what I call magnet attractors. The gaps, the low volume, the fibs, the 200-day, and with that W structure bottom, all giving, credence here to sort of attract up. And that's why I call them magnet attractors. Okay, so that's what's going on, and that's why this relief rally, the bear hunt that I call it, still has legs. If it can get through S&P 2000, then it's definitely going to target the gap at 2040. Here's where it will run into more trouble, though. This is a weekly view of the S&P, and I've got 20, 40, and 80-week moving averages on here just to identify trend. What I want to point out is that this long rounding top we've got going on is having the market spend a lot more time below these moving averages. In other words, as the market gets tired and rolls over and makes that top, it just keeps pushing down with relief rallies and spending more time, giving more time for these long-term moving averages, an 80-week moving average, giving it time to roll over and top. That's the green line you're seeing coming in at 2032, the 80-week moving average. That's about to drop down. You've got the blue and the red, the 20 and the 40-week moving averages already in their bearish cross, and then crossing below the 80-week. So looking for resistance, I gave you all the magnet attractors about why the market could go up. Where is it going to hit its head besides after filling that gap at 2040? The obvious place would be these 20 and 40-week moving averages at 1995 and let's call it 2017. My buddy Dave Bartosiak, who many of you know here, this morning he quipped that the bears are like the designated driver at the party or the bar right now. And, just waiting. Come on, bulls, let's get this over with. We got places to go. We got to get home. We got to get back down, right? I offered that S&P 2040 is the 4 a.m. bar. So if the bulls can talk the bears into it, they're going to leave the party or the 1 a.m. bar and go to the 4 a.m. bar and try to extend this bear hunt relief rally. And that's a definite possibility. But let's get serious. Let's get back to fundamentals. Here is the reason I'm bearish, the earnings recession. This is the latest update from Shiraz's data, Shiraz Mian, our Director of Research. As of March 1st, the earnings estimates for Q1 have slipped to negative 9.3% growth, if you can call that growth. So minus 9.3 for Q1 is where the estimates are now. They just keep slipping down. I mean, 6 months ago, they were expected to be positive. Every month, they lose, a percentage point and a half, and it just keeps getting worse. Q2 has now slipped. Remember, a month ago, Q2 was flipping around, the zero line. Q2 has slipped further to negative 3.6% growth. Q3 has lost some momentum. And even Q4, which was projected to be above 10% growth, has slipped now. And again, that Q4 estimate of 9.4% earnings growth, those are just pie in the sky estimates. The point is that the earnings recession persists. As I've said for 6 months, the forward estimates are in jeopardy. And as long as they're in jeopardy, the market is overvalued. And that's why we're having this valuation reset, because the forward estimates are in jeopardy. All right, so always come back to where are the earnings and what is the state of the earnings recession. Because if the earnings don't stop going down, then the market remains expensive. How expensive? Let's go back to the chart I've showed you since January 28th. Here are my targets for the valuation reset. So what I have here is a multiple that the market might pay. Fund managers might be happy to pay 15 times for the S&P earnings if they're at $120, which they're not. So I'm using $115, and I think even that number for 2016 is in jeopardy, $115. So you have to be thinking about what fund managers will pay. Will they pay 14 times for estimates that are falling? That puts you at S&P 1610. And really that, I think, is a realistic target for how far this valuation reset could go, because that 115 is still in jeopardy. And as long as it is, the fund managers with lots of cash, and lots of them have it, and that's why we're having this relief rally, they want to buy. They want to put that cash to work because they've got historic levels of cash, but they need to wait till valuations get better and visibility is clear. Now, if we're at that 4 a.m. bar at S&P 2040, what is the market banking on? It looks like the interest rate market is pricing in no hike from the Fed in March. Well, what if we get one? Will that be what sends the dollar soaring again? And we've got a new problem for stocks on our hands, being overvalued. All right, so come back. It all comes back to earnings, basically. It doesn't come back to commodities. Commodities are in the toilet. It comes back to earnings. And if the earnings are still headed down, then the market remains overvalued and needs to correct further. That's my thesis why this bear hunt rally will end soon. I'm Kevin Cook. Thanks for joining me in the kitchen.